Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything about the digital asset market. And this week, I am actually joined by Chris Perkins, who is the President and Managing Partner at Coinfund, to go over some of his 2026 predictions. How are you, sir?
I'm well, Jeff. How's it going?
Well, it depends on what your predictions are, I guess. I'll tell you after we talk. Could certainly use a little wind in the crypto sale here. So, hey, before we get started, though, this commentary is not intended to be investment advice, investment research, or recommendation. Consult your investment professional for your own circumstances. So, Chris, to answer your question, I'm doing okay, but the markets are certainly not responding to a lot of the normal factors that normally they would respond to. Certainly over the last 6 to 8 weeks, I'd say it's a pretty big dichotomy in price action relative to news and macro. We're only 3 weeks away from the end of the year, and people are starting to think, okay, well, maybe 2025 is largely over. What does that mean for 26? Would love to hear from you what you think. You can start with what's happening in the market today, but mostly just, where do you think we're headed? What does this mean? Are there any major themes or ideas or predictions that you think are going to happen either in 2026 or beyond?
Yeah, really appreciate it, Jeff. Thanks for having me. I think we're starting to see a theme that's continuing. And to your point, there's so many positive factors impacting our space. You look back a year ago, and the world was a completely different place. We were being attacked by regulators. They wanted us out of business. They hated the asset. Fast forward to today, you have bipartisan support. Our policymakers have said publicly over the last year they want to make crypto the capital of the planet. So you have these incredibly positive factors. Rates are coming down. We've shifted from QT. The era of QT is over. But still, to your point, against that backdrop, we haven't seen that pop. I think a lot of the reasons why we haven't seen it yet is that market makers and retail are still recovering from the stress that hit our market on 10/10. And for those that didn't understand it, the previous administration pushed a lot of liquidity offshore. Like today, we don't have functional derivatives markets that are regulated post Dodd-Frank. I built a lot of the market structure around it. We don't have it onshore because the regulators said, nope, these are securities. So it forced all liquidity offshore to unregulated exchanges. They really blew up during the stress on a Friday night, and market makers and retail haven't recovered. And crypto to date has largely been a retail-dominated market. That said, all this foundational work that's gone on in the last year or so since the Trump administration took over, and we have regulators that are engaged every single day trying to create those conditions, they've shifted the reputational risk from saying, hey, I have reputational risk for being in this market to saying, hey, I have reputational risk for not being in this market. And so I spend a ton of time speaking to institutions, my traditional friends where I came from. I just got off the phone before this. These institutions are methodically moving forward. They don't move as fast as some of the crypto folks. They definitely don't move as fast as the hot ball of money that we call retail, but they're methodically moving forward. And so you're going through this flipping now in the markets where retail and the market makers, the crypto natives, are still recovering. The institutions are marching forward. And so what does that mean? That means a number of new products are going to start coming online in 26. I'll start where one aspect of that, I talked about it earlier, is derivatives. We have a huge hole in derivatives right now. You can only really trade barely 4 listed futures. I used to run futures at Citigroup. You can barely trade 4 of them regulated onshore in the United States. And that's awful.
Those 4 being Bitcoin, ETH,
XRP, and Solana, right? And the latter 2 were recently launched, right?
And barely functional. I'd say it's 1A, 1B, but sure.
Yeah. And so as institutions start coming into this market for the first time, the regulatory risk is really off the table. The operational risk is really off the table. And why? Because they can, even if they haven't figured out crypto yet, they can still buy ETFs now, or they can buy DATs. And DATs are starting to extend in digital asset treasury companies where you wrap that those crypto assets into a security. So they can still trade it the way they like it with securities, but what's been missing are those alt futures.
Yep.
And so, speaking to regulators, they're like, look, we don't think everything. Atkins keeps saying it. He's like, look, most of this stuff, they're oranges. These are commodities. These are not securities. that opens the door for the regulated exchanges to start listing products, which is going to be a massive unlock for institutions. Because again, institutions, they struggle to go long crypto assets. Even though all those risks are off the table, the one thing that remains is market risk that they really understand. It's just too volatile. Like if you're at a major hedge fund and you're down 15% in a month, they may show you the door if you're a PM.
And how would you estimate, because I've seen various numbers and I've not run them myself, but the amount of derivatives in traditional markets as a percentage of overall activity is pretty high relative to the derivatives trading in crypto. When we say derivatives, we mean futures trading and options. I know everyone talks about futures exchanges and all that, but like it's still a relatively small part of the overall crypto trading, whereas in the equity and debt world, derivatives is a massive part. Like how much growth are you talking to catch up to what we've seen in traditional markets?
So again, in any natural market, derivatives will far surpass by multiples. I don't know, depends on the market, but like we're not talking that they're even close. Multiples and multiples in notional volume. They're just deeper liquid markets. By the way, they're also the most profitable business if you're an exchange. There's a reason why ICE bought NYSE and not the way around. It's just a better business model, higher volume, much more profitable for folks. So I don't have the exact number, but the natural stasis, yes, derivatives are high. Let's talk about it now. So the problem is that if you want to trade most derivatives in the United States, yeah, you can do some OTC trading on options, but it's really all offshore. And so if you are a major institution and you want to get into this space, it is very, very difficult for you to trade comprehensive derivatives in our markets. And so like I would say, like we're almost, aside from Bitcoin, ETH has had a good year, that's all you can do. So see this massive gap. And I think, again, as these institutions come in, they're not going to go long. They're trading basis. And that's the initial driver that we saw with like IBIT and the BlackRock ETF. They buy the ETF, they sell the future. Classic basis trade. You're going to start seeing more of that in alts. And yeah, maybe it's not, the most exciting trade in the world, but it's going to give institutions the ability to start underwriting and understanding these assets and coming in.
And it's a huge boon to liquidity, right? I mean,
massive boon. And like, look, basis trade is very good for spot prices. Buy spot, sell future, spot go up, right? And these are all cash settled on the futures. And obviously the price will come down as you unwind that trade. So one thing we look at very closely is basis, because basis can kind of predict. If the basis collapses like it has recently, I mean, why do I even care? Like, I'll just trade, like I'll find traditional asset classes to find better basis. So that's something that I'm watching very carefully. So that's one of the first things I think that we're going to see in 26. I can pause there and go on to some of my other shenanigans.
And do you think that is CME, which was obviously dominated in terms of regulated futures trading for Bitcoin and ETH, or do you think that's happening somewhere else? Where do you think this goes?
Amazing question. Liquidity, like you and I know, been around long enough, Jeff. Like, there's no magic formula for liquidity, right? It happens, and then it happens, and it's very hard to move liquidity to other venues. There's a famous example where Deutsche Börse, by electronifying bond futures, they were able to move it across from the pit into Deutsche Börse Eurex. But there's very few examples where there was just like immediate catalyst. That said, I think you're going to see exchanges coming in really hard into the space. And I do think that there is an opportunity to shift liquidity from the incumbent, which is the CME, into whether it's an ICE, whether it's some of these foreign players coming onshore right now. I think this is going to be one of the major battlegrounds that you're going to see in 2026. I think they're coming back hard. They're going to compete for liquidity. There's no magic formula. If somebody had it, they wouldn't be here. But they're going to try everything from fees to innovative products to new marketing capabilities. Because this is really the next big thing if you're a derivatives exchange.
And what's your gut tell you? Is that Binance coming over to the U.S.? Is that Coinbase building it out through their Deribit acquisition? Is that, like you said, ICE? Is it maybe some of the decentralized players like a Hyperliquid? Like, where do you think? What's your gut tell you who wins that race?
I was going to get me in trouble for sure, but I think it's hard to. If Binance comes back and enforce, and they're able to generate liquidity, I think they're always a force to be reckoned with for sure. I think ICE is really interesting. ICE is founded by an entrepreneur, right? And he's the CEO, and he has that entrepreneur ethos, Jeff Sprecher.
Mhm.
And what did he do? He just did that deal with Polymarket,
Yep,
right?
massive
So
$1 billion investment in Polymarket.
right, and so like, what do these guys need to solve for to stay relevant? Prediction markets. They need to solve for perps, which are the regulations going to allow for that. Tokenization. And so like there is a lot of volatility right now. If you're fighting against instead of pushing with, I mean, these are 90, $100 billion market cap companies. They could go to zero overnight if they're not careful. Because again, liquidity doesn't move until it does, and then you're toast. And
Yeah.
so it's a really interesting place to be.
And I think just as an add-on before we go on to the next topic, I think look, whether it's good or not for society remains to be seen. But there's no question that the world is heading into more and more of a gambler mentality, and we've seen it with the rise of prediction markets. We've seen it with the rise of zero DTE options, right? Daily settle options. You've seen it with sports gambling. You're seeing it with perp dexes. Like the market wants to, the society wants to. Do more short-term, high dopamine, lottery ticket type trading, and perps are natural for that. And I think, perps becoming the norm, not just in crypto, but across, equities and other instruments as well, is certainly going to be a huge, as you said, a huge battleground going forward, especially as you see tokenized assets moving onto perp exchanges.
Yeah,
So,
100%.
well, great. Let's move on. So, prediction number one was the rise of liquidity and derivatives and basis trading on non-Bitcoin and ETH assets. What's prediction number two?
Yeah, also throw on before we get off that one is fixed income. Rates, $500 trillion market. You're going to start seeing a little bit of rates trading coming into play. What rates am I talking about? Staking rates. I'm talking my book. We have a rate called Caesar that we incubated, the risk-free rate of Ethereum. You'll see that for Solana or rates like those, but like rates trading was going to start as well. Fixed income markets. You're going to see more unique debt instruments as well. DATs will come up with unique crypto native structures. So I think in addition to futures, I would just say fixed income as an asset class within crypto is very nascent. It's actually a bigger market than equities. If you look at a comparison, fixed income, I think, is like 145 trillion in market cap in traditional markets, where equity is like 127 trillion. I believe that market is underdeveloped. Like crypto native fixed income is underdeveloped. And I think that would be.
But who's the audience for that? I mean, that's always been the problem is like, for instance, since Arca's been doing this, everyone said, well, when is Arca going to tokenize its LP interests in its fund? And we're like, there's no demand for that. Like anybody who wants to invest in our fund can already do it the traditional way with wires. There's no extra people sitting around in the crypto world yet who want to buy tokenized LP interests in our funds. And the same thing is true of fixed income. Like who are the people that are sitting around here, sitting in stablecoins that are looking for more fixed income products? Like you still have to bring in the masses before you bring in an audience who cares about lower returns. Today's audience is, again, these high velocity dopamine,
exactly. Yeah. So it's consistent with the theme of institutions coming in and identifying basis and opportunities. I'll give you one example. Ethereum, it's a wonderful basis trade, right? You buy the spot, you sell the future. Why are you leaving all that juicy yield on the table? Like the degens will say, oh, it's like 3%. Nobody cares. I'm going for a 5 or 10xer, right? But when a hedge fund comes in, a really smart hedge fund, they're not leaving 3% on the table. Oh, and then they're going to say, well, wait a second. That's like a 2.5% real yield. It's better than treasuries. Wait a second. And so like, as I'm trying to explain, like the sophistication, the institutional sophistication as it comes in, then you're going to see fixed income markets blow out because these guys understand how to squeeze every last piece of yield. And the one thing that even the degens understand, right, is that yield really matters. And that'll probably bring me to my next prediction around stablecoins, to be honest with you.
Okay, well, let's get into it. What's number three?
Yeah, so stablecoins. I thought last year I called 500 billion in market cap. I think I'm going to come up a little bit short. But the trend is going to be vertical. A lot of I'm seeing this every single day. There's a few ways to monetize if you're an institution. You can monetize through trading, whether it's spot, okay, derivatives, awesome. And then like putting on my old futures hat, right? I would make money in different ways through fees, net interest income, and maybe data. Those are the 3 monetization vectors. Fees are pretty obvious. When I start thinking of net interest income, that brings me right to stablecoins, right? Because somebody is going to capture that, and rates are coming down, whatever, 3%, which is a lot when you have a product, particularly for scale. And so there's going to be insurmountable interest in the growth of that asset class. I'm predicting it's going to go, it's going to about double in size. I'm saying 600 billion. Probably on the low end if some things happen. The thing to watch with stablecoins and getting to 600 billion, the Treasury is saying 3 trillion in the next couple of years. I think that's kind of it's going to fall short. Why? Because we're going to be tokenizing the entire equity market. And remember, I said it's a $127 trillion asset class. You know, when that starts tokenizing, when fixed income starts tokenizing, trading 24/7, you got to pay for those assets in something. And what are you going to pay for it in? Stablecoins. And so as tokenization grows in size, so will stablecoins. And then, I don't know, I'd love your perspective, Jeff, but at a certain point, the liquidity will be where you have to buy the token. Because if you buy the old asset class and China invades Taiwan on a Saturday night, you're kind of caught. Right. And so assuming you meet a certain liquidity threshold, then overnight you have to trade the token.
Yeah, I think it's inevitable. That's where we're headed. I always compare it to, you know, when the internet first came out, and you know, some people immediately threw their credit cards on there. Others were like, "No way, am I ever putting my credit card on there? That's crazy." And now everybody obviously has their credit card on the internet. And same thing with, like, you know, when you used to fly in a plane, and all of a sudden the kiosk came about, and you could have, you know, your phone or get your plane ticket on your own, versus the people who still went to the counter or had their tickets mailed to them. Like, there was like a real split for a long time, and then now everybody, of course, just, you know, has their mobile boarding or goes to the kiosk. So there is that sort of Malcolm Gladwell tipping point that happens at some point. And to your point, it's usually because either liquidity or because they have to, right? It's going to be because there's some stock that just, they have no choice, they have to own it, and the liquidity is better on chain, or it's only available on chain, or it's going to be, like you said, some war that happens on a Saturday night, and the people that were on chain were able to react, and the people who weren't on chain weren't, right? There will be a tipping point for sure, as it pertains to that. But I think the two follow-up questions I have with your prediction on the stablecoins is, one, well, who ultimately wins that race post the Genius Act? Is it really going to be a two-horse race with Tether and Circle, or is it going to be JP Morgan coin or PayPal coin or Venmo coin or Facebook coin or whatever else that comes about, right? Like, so that's my first question. Answer that before I go into my second question. But how do you see that playing out? Where does this growth of stablecoins come from?
I wrote an article a bunch of months back. I call it the stablecoin Hunger Games. And it's going to be a massive battle, because what you're going to do is you're going to take their stablecoin, you're going to dump it, and you're going to issue yours, because you're going to want to vampire attack that yield. Circle and Tether are in great shape. Tether, particularly overseas. I'm curious to see how they're going to get product market fit here. I was talking about it with one of my colleagues today, because they're not going to give any interest. Right. I think other folks are going to be throwing around interest. But again, back to the earlier point around liquidity, you just don't know what creates it. Like, other folks have been giving out plenty of interest, and they just haven't caught on. So I don't know. I legitimately don't know if it's one of the incumbents today, or it's going to be someone who comes in, or a consortium perhaps of banks. I think there's a high likelihood a consortium of banks come together. They're like, hey guys, here's our stable coin. We're all going to share in the profits. Like, that's the one for us.
That's what I always thought as well. Like, you know, similar to kind of like how ISDA agreements work, and how it's like JP Morgan isn't going to use Merrill coin, and Bank of America is not going to use Goldman coin, but they might all use Wall Street coin.
They're going to use Wall Street coin. That's probably how I think it's going to play out. And then the next battle is going to be settlement layer. Notice how I didn't say layer 2 or blockchain, settlement layer. Where does this thing settle, right? Who owns the sequencer fees for that settlement layer? That's the other vampire that's waiting in the mist. People are going to be fighting for that settlement layer. So, yeah, I don't know. I wish I knew.
That settlement layer kind of dovetails into a thesis that I've been, you know, kicking around now for half a year, is that what we've learned with blockchain is that you want to own the sequencer fees of the L1. You want to control the network. You want to actually have that audience and that network effect. But what we've learned is the reason all these L1 tokens just go straight down is because you can't put a valuation on them when they're, you know,
Yeah.
Ethereum at 400 billion market cap with only 2 billion of fees.
Yeah.
And you know, you barely even have to hold any ETH in your wallet to use the network. Same with Solana, right? I mean, you could do things on Solana for your entire life and have less than one soul in your wallet to do it.
Yeah.
So as a result, most of the value of these L1s comes from like social value more so than actual financial value, unless you also own the stablecoin and the DEX, right? So basically, like, you want to have a vertical integration where you have the L1 to keep people there, but you make all your money on the stablecoin and the DEX. And we're seeing iterations of that vertical integration, right? You have guys like Hyperliquid, Binance, and Coinbase started as exchanges and are now branching into stablecoins and layer ones or layer twos. You've got guys like Circle and Tether that started as stablecoins and are now branching into building their own L1s, and then you got like Solana, who, you know, the people, Solana community is complaining constantly about, like, well, why are we giving up all this money to USDC and Tether? Why don't we have our own stablecoin or have our own DEX, right? So it's like, you can see the world heading in that direction. Is that what you mean when you're talking about like the settlement layer, like how they actually monetize?
Yeah, I guess I'm more of a Metcalfe's law guy, and I do see the value in having the value through network and community. I think that there is real value there. On revenue, you know, gold, oil, you know, that it's not making revenue per se, but there's utility around oil specifically. So if you look at ETH as an example, you're going to be staking if it does get that network effect and it becomes the world computer. And like what I'm seeing is, I'm seeing a lot of institutions, that's the first stop, for two reasons. One is the modularity, that they can afford themselves through a layer two and they can have that control and they can capture those sequencer fees. And number two, it's been around for 10 years and hasn't gone down. And like 10 years of history when you work at a bank is a big deal. A lot of that's going to get locked up in staking. There's certainly economics there. We can talk about how it's a decent real yield, but then like you're going to need it. You're going to need it to settle on that layer, and so it's not really an inflationary asset. So I do see some value through that commodity lens and utility, where you're going to need it for gas fees. And yes, gas fees are coming down, but it's a question of scale. But getting back to the settlement layer piece, again, whether I do think modularization for institutions is going to matter. They want to control it to a degree. They want to optimize it for, you know, either TPS, maybe not security, maybe lose layer one or whatever. But if they can capture those sequencer fees as a third fee vector, I think they're going to like that.
All right, here's my second question with regard to that. Every conversation I have with institutions goes the exact same way. It's some iteration of, we love the idea of tokenization in real world assets. We love the idea of stablecoins. And we love the idea of DeFi. Those are the three areas where you know, any chart you look at, DeFi exchange volumes are up and to the right. Lend borrow on Aave and other places up and to the right. Stablecoin AUM is up and to the right. Real world asset tokenization is up and to the right. Like, those are the three areas that everybody talks about. But they talk about issuing, not investing, right? They want to be the issuer of the stablecoin, not an investor in stablecoins. They want to be the issuer of the tokenization, not an investor. So it's like we have this disconnect right now where everybody wants to build and utilize the three main growth areas of blockchain, RWA, stablecoins, and DeFi. But the only thing people talk about from an investment standpoint is Bitcoin. So how do you bridge that gap? How do you get to a point where literally all of the growth that's happening in blockchain is happening in three areas that doesn't at all have anything to do with Bitcoin, but all the investment dollars are flowing into Bitcoin?
Yeah, we need better storytellers and utility and fundamentals, right? I think there's some projects that have incredible fundamentals, but I don't think their story has been told very well. I think the DATs are actually helping with some of that storytelling. Like Tom Lee with what he's doing with Ethereum, I think is profound. I think what Danny Ives is attempting to do with something like WorldCoin is interesting. So look, I think fundamentals matter. These guys, most of the institutions couldn't even look at the asset class a few months ago, right? And so it just takes time, as you know, Jeff, to understand it, to underwrite it, you know. And I think a lot of the good news is a lot of the operational complexity has been abstracted through security wrappers and things like that. So that's just a matter of time where they underwrite those fundamentals just like any other asset class. And that's the cool thing about it, is like, you know, you can underwrite anything, as you know, as an investor. It just takes time and education. But that hot retail ball of money is a different story. You know, it comes and goes.
Okay. Well, great. Well, I think you have one more prediction. Is that right?
Well, here's one that I don't want to talk about, but I think, if I'm going to be honest with you and everybody else, I think we have a huge security problem. And I'm concerned that there's going to be a really major hack in the next year that sets us back materially. And so it's something that I stay awake at night thinking about. Not obviously if you run a fund, and I know you guys think about it, but that's not really what's as concerning as something that's big and macro and takes the confidence away. And if anything that's going to undermine innovation, it's security.
Yep.
And I see very sophisticated people getting hacked. It's something that we need to be much better at, I think, as an industry. So my prediction is that there's going to be a big one, and then that will result in a material policy response, both positive and negative. Maybe short-term negative, longer-term really good.
And when you say, something that's big enough to get people's attention, you're talking about a Coinbase or a Binance or a Tether, like
I'm talking about in the billions. Yeah. I don't usually say bearish things, but I'm just being honest. What do you think?
I think that's always a massive risk, but I think most of the hacks that have happened to date are either at the individual level, right? Very sophisticated, but they're targeting an individual who independent of how amazing these guys are. It always typically comes down to user error in some regard.
Yeah,
we haven't seen one at a massive. I guess was it Bybit? Yeah,
Bybit was big, and here's the concern: you got 600. We're on a road to $3 trillion according to our treasury in stablecoins alone. As people are getting into the space the first time, do they have the hygiene? Do they know what they're doing? I think about it every day. Do these newbies really do so? That's my concern.
Yeah. Yeah, and like you said, there's only a handful of players that are big enough where a hack of that size would lead to a policy response. You're talking about, like I said, something like Bitmine or MicroStrategy on the DAT side, or something like a stablecoin or something like an exchange. So, I'd say that's always a huge risk, and something that this industry, I'm not sure that risk ever goes away, quite frankly.
Yeah, cool. Well, that's all I got, man.
Well, I appreciate you leaving us on a downer.
Sorry.
But no, this is great, Chris. I appreciate this. This is helpful for our audience in thinking through 26. Where can people learn more about you, about Coinfund? What's the best way to...
Just Twitter, Perkins CR97. Thank you.
Well, perfect. Well, Chris, thanks again. I appreciate you coming on. And to everyone else, happy holidays. And we'll have other predictions coming out from other guests shortly. But that's it for this week's. That's our 2 Satoshis, and we'll be back soon. Thanks, everybody.
Thank you. Thanks, Jeff.